Hello, everyone, and thank you for taking the time to join Cobalt Blue for this investor webinar. Today, you've got me as your host. My name is Joel Crane. I'm Investor Relations and Commercial Manager. I've also got with me today CEO Andrew Tong.
Thanks, Joel. Really want to extend a warm welcome to all of the viewers today. It's great to be here and talk about our company. I just want to thank you for giving up your time to listen to us. We're at a really exciting inflection point for the company as we move into 2026. There's a huge amount of interest in this sector, and we'd love to have your participation in this presentation today. I'll pass back to Joel, and he's going to kick us off.
Thanks, Andrew. So really the intention of today's webinar is to cover three things. First of all, talk about the problem in the global cobalt market and why Australia and the US are focused on finding a solution. Then we'll talk about what is Cobalt Blue's role in this solution. And then finally, we'll wrap up with an update of the status on the refinery and other parts of the business. Okay, let's move into it. Let's talk about the cobalt market itself. This chart says a lot. It's obviously a very highly concentrated market. And when you look at this, a number of things become very apparent. The non-China and FEOC section actually has a lot less reserves than perhaps some of the other parts. And what that tells you is that the non-China segment has actually underinvested versus reserves, and we're producing a lot less than could be. Obviously, the DRC is by geography the largest producer, but it's China that actually controls the market because of the ownership interest in so many of the DRC projects. And then in the final segment, the refining, there's very little non-China refining. And most of what's left over is wrapped up in long-term supply contracts. So basically unavailable to new segments of the market, like what the US is chasing at the moment. But as everyone on this call is probably well aware, the cobalt market is fortunately undergoing a structural shift. And it all started back in February earlier this year when the DRC put a temporary ban on exports of cobalt to the rest of the world. That ban has now ended, but they did put in place a very strict export quota system for the rest of this year, as well as 26 and 27. So what that chart is showing you on the left is based on what the initial announcement of these quotas, the cobalt market's going to be very tight and in fact undersupplied. Luckily, the DRC in the details of the legislation has allowed itself the flexibility to increase those supply of those export quotas if the market is showing a regular need for that. Obviously, the price is responding to this shortness very quickly right now, and the DRC government's going to do its best to try and keep that price run under control. We believe that the DRC thinks that the optimal price is somewhere between $20 and $30, which we're sort of there today. So we think the prices will sort of settle in this newfound range over the next several years, which is obviously good news following several years of very low prices because of that predatory oversupply that we saw before. Just moving on to talk about cobalt demand a little bit. I mean, it's still a battery story. As you can see, the lion's share of demand goes to the battery sector. But this year, it's been a lot more focus on the non-battery sector or the industrial sector, specifically the cobalt that goes into alloys and steels and magnets. And that's really what the US is chasing at the moment and what they're trying to secure. And that's also the reason we've actually focused a lot of this year on maturing our flow sheet to be able to produce metal. And with that, Andrew, I'll hand it over to you to give us an update on the company's strategy and the refinery itself.
Thanks, Joel. As a bit of a summary there, the cobalt market is now being heavily managed by these quotas coming out of the DRC, and there's enough flexibility there to respond quickly to the market. Our strategy, how do we fit into this? Our strategy is to build our Kwinana refinery as quickly as we can. That refinery will initially start with imported feedstock from Glencore, from the DRC. We will be buying cobalt hydroxide and processing that into cobalt sulfate and cobalt metal, as Joel shared on the previous slide. Longer term, we would like to incentivize domestic cobalt production in Australia. Obviously, we have our own Broken Hill cobalt project, and we're aiming to submit some permits on that soon. That's our next step on that project. We'll touch on that a little bit later. We're exploring some opportunities with other projects in Australia, so that long term we may be able to enter into cobalt supply agreements for our refinery. And we're also starting to move into the recycling space, looking at cobalt from battery black mass and other sources of cobalt. So we want to build our refinery as quick as we can. It's viewed as an enabler. By doing this strategy, we're able to de-risk the downstream markets, get into the heavily regulated and controlled markets for the battery industry, which have very, very high validation hurdles, get into those markets, bed all of that down, and then we're able to come back and apply our capital and efforts to our mining project, having de-risked the offtake. So that's a really important aspect for the banking finance. When banks look at these mining projects and they look at volatile commodities like cobalt, they need to have confidence on the downstream offtake. And the best way to do that is to build the offtake and spend all of our efforts on that upfront. So that's our strategy. In terms of the Kwinana refinery, a bit of a deeper dive into that. Long-term parties would realize that we're heading towards a 30%, 70% JV with Iwatani, Japanese trading house. We have a very strong relationship with that group. They own facilities in Kwinana at the moment, and we'll show a picture of that in a moment. So they have facilities down there. They're making fused zirconia from the mineral sands business. We're aiming to build a new shed on that site, and that gives us a great advantage with the opportunity to go straight to construction. This year, it's been a big shift for the company. We've put in place an overarching agreement with Iwatani to move to FID. So that agreement laid out a series of activities, and we've been working through those. Number one was to get our binding feedstock agreement with Glencore for cobalt hydroxide. We've now received the permits from DEWA, from the West Australian government department there. Those approvals allow us to move ahead with the project and to operate the project. Of course, there are secondary approvals that we need to apply for, like dangerous goods licenses and so on, and we'll do that in due course. So from a summary perspective, we have our feedstock in place, we have the permitting in place, we have a number of letters of interest on offtake, and that's our key focus between here and the end of the year or into January next year, is to convert those offtake agreements into binding agreements. That's a critical piece to then enable both Iwatani and Cobalt Blue to make the decision to go ahead with project finance. So everything at the moment is focused on these offtake agreements and getting those secured. As you would have picked up earlier, we're looking both at cobalt sulfate for the battery industry, and we're aiming for alloy grade cobalt metal into the defense and alloy industry. There has been a lot of work this year in Broken Hill at our technology center, and I'm pleased to share that after all that effort, we have made the products at the required specifications for the cobalt sulfate, and that's unlocking a series of really good discussions going on that front. We're continuing to work at the alloy metal, and that's certainly something that we're hoping to conclude fairly soon. So largely the project is really well positioned at the moment. There is still work to do, but really well positioned to execute over the next numbers of months. Where do we want to be? We want to be supplying 10% of the non-China related cobalt, and that's the market gap that we're moving into. What do we see at the moment? We see a great set of interest from the Australia-US Framework Agreement, and they're really interested in projects that are on the processing side rather than just purely the mining projects. Here with this photo, you can see the site at Iwatani. Because it's an existing site, we have that opportunity to have speed to market and going into this site where there's already power, water, offices, laboratory, fence, people, all those sorts of things. So it's a very, very fast to market opportunity for us to go in there. And that's why we're so thrilled to have Iwatani as a partner on this project. You can see here some of the 3D drawings. We've been working with Tetra Tech as our engineering partner. There is further work to do. We need to finalise these plans and lock them down. Now that we've got the permits, that does come back and reshape some of the final engineering. For example, where do we put our stack? How do we put some of the water connections in and so on? They come out or flow out of that permit documentation. So I'm really excited to go to this site. This site's super well located on the main road in Kwinana. Great access to Fremantle Port, where we'll be bringing feed material in and exporting our material out in the containers. The last two slides that I wanted to touch on was our technology centre in Broken Hill, and just reiterating that as we've moved through the Broken Hill demonstration plant work that we completed a few years ago, it's now been focused on the refinery. It's been completing the cobalt sulfate and metal production, but we also always continue to evaluate new feedstocks because we know that the market is changing. We know that over the long term, we need to find domestic cobalt opportunities in Australia. So we continue to do evaluation projects around either other intermediates from mining projects, or particularly now as we look at the black mass opportunity from the battery recycling space. That facility is fully permitted for these sorts of activities, and we're looking at launching some further programs into 2026. So stay tuned for further updates on that. The last slide is just wrapping up on the Broken Hill Cobalt Project. As you know, this is a great opportunity for Australia and for ourselves. There's 80,000 tonne of contained cobalt in our mining plan for that project. We continue to look at how we can optimise capital and operating expenditure. But the next step on this project is to apply for our permits. One of the big things that has come up in a lot of the banking discussions that we've had is that we need to get the project permitted. And we're really pleased to see a lot of effort through the Australian government looking at how to streamline the permitting process for projects like this across Australia. That was a key aspect of the US-Australia Framework Agreement, is to look at permitting. And that's at an opportune time for us as we look to submit our permits on the environmental side for this project over the next 6 months or so. That's a bit of a wrap from me. Love to get into Q&A. So Joel, I'll hand back to you.
Thanks, Andrew. There are a lot of questions, but I think the most pertinent one that we should probably address straight away is how does the US-Australia framework impact Cobalt Blue? I'll just throw to you, Andrew, for the first cut at that.
Thanks, Joel. Yes, this is the topic du jour. Everybody is talking about it. I've been at IMARC conference this week for a few days, and everyone's discussing what does it mean. I think there's a couple of takeaway points that I'd like to share. Number one is that it strengthens the framework between the countries to look at our sector. And what does that mean practically? It means removing barriers for investment. It means opening up mandates for different agencies to work across borders, to work more collaboratively around bespoke financing opportunities. And I'm picking words there that are directly out of the framework agreement. You can search online and find a copy of the agreement. But there is specific language in there about opening up all the opportunities for finance. So equity, debt, offtake, pricing floors, contracts for difference, all these sorts of things. So having that framework agreement removes the previous barriers and opens up a lot more opportunity for creative financing of projects. That's number one. Number two, it shines a spotlight on our industry, and Joel's just sharing one of the slides here. One of the critical things that we have been discussing over the last couple of years with all the governments is the lack of processing capacity. Australia has some fantastic opportunities in the ground, but where we lack is the processing opportunities to refine and separate these metals. And I think that's a key part of this framework agreement, is to invest a lot of money into the processing side, because that's what's going to start to unlock the supply chains. It's great that we've got the mining, and it's great that at the other end there's industry, but the processing is the link between them. And for us, Cobalt Blue, that's where our strategy around building our refinery fits in. The refinery is a processing step. It's a small capital play. A capital stack for that's about 120 million Aussie dollars. It might change a little bit, but that's our latest information. And that's a small that's a small capital piece to have a large enabling effect on the cobalt supply chain.
Thanks. Yeah, it's just very obvious what the sort of project scope and type that this consortium between the US and Australia is looking for. So it's projects. Yes, it's good to have the mining behind it, but certainly it's going to have to include processing, and it's going to have to be investment ready. Moving on to another question that came up a few times. Last week, there was an ASX released by our friends at Legacy Minerals with detailing an MOU between us and them. Andrew, can you just give us some detail on what that MOU actually entails?
Sure. This fits into one of the comments I made on the slide pack. Our long-term strategy is to try to secure as much domestic Australian cobalt as we can. So we're interested in talking to explorers or project developers that have cobalt in there. And obviously they're nickel projects or copper projects predominantly. And so we're out talking to groups like Legacy, and we would like to think that there'll be other MOUs. In the short term, what it means is that we'll be doing some evaluation, some test work, some desktop engineering and so on. Long term, we're trying to set the scene to have supply agreements of cobalt intermediates and so on into the Kwinana refinery. That's where we'd love to place that project. Unfortunately, at this point in time, there are very, very limited, if any, cobalt intermediate supply opportunities for us in Kwinana, but we want to help develop that industry. So that's why we're doing those sorts of agreements.
That's right. And, we're also in talks with a number of other companies in Australia. So hopefully these will also develop into a similar potential commercial relationship. Andrew, there's a number of questions specifically around the refinery. So let's get into a bit of detail here. You're targeting first operations within 18 months. Is the construction really going to take that long? I mean, you outlined a pretty simple looking process. I mean, can you just run us through a few of the milestones and then perhaps risks around that construction period?
Sure. I'll run you through how we view the runway from here. Number one, offtake. We've got to convert LOIs into binding agreements. That takes a certain period of time and a fair bit of negotiation and legal contracting work to do that. That's really important because it unlocks the finance. There's a number of parties looking at financing the project, but all of them need to have confidence that the product we make, we can sell and that there's reasonable returns on the project. So it's offtake, number one. Number two is project finance. Once that's all bedded down, then we can move quickly into the construction period. We're anticipating that construction will take 12 months minimum, but 15 or a bit more months, depending on how quickly we can identify the contractors, how quickly we can move into those contracts. One of the pieces of the puzzle is to move on some of those things as early as possible. We'd love to be in a position to start developing up the documentation around contractor engagement and long lead items, but we can't do that right today, but that's where we'd love to make a start on that and start to bring in that timeline. Where does this all lead us? What it means is that we're targeting to have built the project somewhere around the second half of 2027 and be moving into ramp up and early operations at that point. I want to then touch on the fact that we have two products, cobalt sulfate and cobalt metal. The cobalt metal we will be able to sell essentially straight away from the project, but the cobalt sulfate will need to go through a validation period. And that comes back to these offtake agreements, is laying the pathway to that validation. Yes, we've made the sample at demonstration plant level, piloting level, but to go into the full binding agreements down the line, we need to provide sample from the actual Kwinana plant and go through that process. So we're beating down those timelines and pathways, but that's a bit of a sketch. Where are the risks? The risks right now are around the offtake agreements and getting those into a suitable form that unlock all the other steps.
Okay, thank you. And just while we're on agreements, how about the supply agreement? We announced it was in May, I believe, a binding agreement with Glencore, which covered 50% of our feedstock requirements. What about the other 50%, and what are the other opportunities for cobalt intermediate feedstock?
Sure, this is a very big topic. It's worth just diving into that with a little bit of detail. We executed that agreement with Glencore with a specific target in mind, and that target was 50% of the initial project production, which is 3,000 tonne contained cobalt. So we signed that agreement for 1,500 tonne cobalt. We did that because that's in accordance with the work that we have going with Iwatani towards FID. What I want to share with the viewers today is that we're really an offtake driven throughput strategy. For example, if we signed a bunch of offtake agreements and there was demand for a product at 4, 5, 6,000 tonne cobalt, then we'd go back and renegotiate feedstock agreement. The reason that we view it through that lens is that we know how difficult it is to bring new product to the battery market. And so we're starting small, deliberately, at 3,000 tonne contained cobalt. But as the market has moved, as the dynamics have moved, as the global supply chain has moved, we're actually receiving interest for a little bit more. But we need to finalise all the offtake, and then we'll go back and backfill the feed supply to meet that. In terms of opportunities, there are opportunities to potentially increase our feed supply from Glencore. There's another project in DRC which has all the ESG certifications in place as well as Glencore. That's our real constraint. Working with the DRC, we need to confine ourselves to the 2 or 3 projects that have all the ESG credentials in place. So we can't just go to anybody. We have to have that as a starting point. So there are a couple of projects there, but a lot of the material sold on the spot market. And so we need to work that through into our financing strategy, is to have some contracted feed and some from the spot market, but have that security there that we can supply our needs. So that's kind of how we'll be approaching the feed supply side.
Great. Maybe just one more question on the refinery. There's a number of questions just around environmental concerns or permitting, and maybe describe a little bit more exactly what the works approval is. I think this is important because this is not a mining project, which has a number of very complex permits and things that are required. Can you just run us through what the permitting like and sort of environmental risks and things are around for a refinery?
Sure. The best way to address this question is to talk a little bit about our operations. What will we be doing? We'll be importing cobalt hydroxide in bags inside containers. So on our current projections, we'd be bringing into the country approximately 10,000 tonne of cobalt hydroxide. Every container holds 20 tonnes. You can do the maths on how many containers a week would be coming through Fremantle Port. They'd come to our site, they'd be unpacked, we would process that cobalt hydroxide, we'd then produce cobalt sulfate, cobalt metal, they go back into bags or into drums, back into containers, leave our site and go back out through Freo Port and out to our customers. So part of the permitting for this project has to consider that logistics supply chain, containers in, containers out. Then we look at emissions. What are the emissions from this chemical manufacturing plant? Essentially the emissions of steam out of the process. So we have a stack, we have a scrubber there to treat that off gas to make sure that there's no acid or other emissions, and essentially a bit of steam. So a bit of water vapor is what comes out of the plant. We have no liquid emissions. We don't have acid going down to water treatment plants or anything like that. It's all contained within the site. So there's no liquid emissions. We do have some leach residue, because as you can appreciate, when we're bringing in this material, there are trace amounts of iron and other things like magnesium and calcium. And so we'll be generating a little bit of solid waste that falls under the guidelines for heavy metal waste. and we'll be disposing of that into landfill in the local area. So that was part of the approvals process, is to look at that leach residue and look at the level of the heavy metals in it and to approve that for disposal. Within the process, the general risks are like they would be for most chemical plants. So there'll be acid, there'll be limestone, handling of those, safety around that for the people, those sorts of things.
Great. Moving on, and there are some other questions about Broken Hill Technology Center and some of our other strategy, but there's also questions around the market. So I think maybe we would take a step back and sort of look top down again. China placed export controls on rare earths a couple of weeks ago, which obviously kicked off a lot of this discussions and media we're seeing lately. Have they done the same thing for cobalt? I'll take that one, Andrew. The short answer to that is no. There were some separate announcements the following day after the rare earth export controls about placing export controls, very, very different than restrictions. These are just export controls, so basically you need to get special permits to do so. But they placed these on high-performance cathode technologies and precursor. This is mainly the technologies around them, the IP, as well as the equipment to produce them. So this policy is specifically more about controlling the flow of that technology and the equipment to make precursor and cathode, as opposed to putting controls on the actual raw materials, i.e. cobalt, sulfate, nickel, manganese, all these sort of things that China dominates as well. They have not placed those similar restrictions that they had on rare earths. Will they on cobalt, manganese, nickel? We don't know, but that's something that's out there that I think you get a little risk premium in the market about that. So to be clear, there are no export controls on battery raw materials yet. Another question concerning the market: what industries are projected to be major consumers of cobalt over the next 5 to 10 years? I did touch on that a little bit, but I think it's quite important to remember the demand profile of cobalt itself. Despite the very weak prices over the past 3 years, demand has been fantastic. We're talking of a CAGR between 7 and 10% over the last several years. And that's primarily because of the growth in the battery sector. Yeah, there's a lot of talk about switch from non-cobalt and nickel containing chemistries to the LFP chemistries, and that's certainly occurred. Yet growth in cobalt and nickel chemistry batteries is still massive. In the markets where that's focused, namely Europe, North America, it's still climbing very, very quickly. And at the same time, so has the other segment of demand, which is industrial demand, which is obviously what the talks around the U.S. are about, and defense. And you may have seen the stat on that slide I had put up before, but for the first time, a very long time, all NATO countries have allocated at least 2% of their GP towards defense. So that is a potential very strong area of growth in defense and in other industrial demand. And finally, we get this question a lot in terms of non-vehicle batteries, or the LCOs, or the batteries for portables. That also has a very large growth segment, mainly because of drones, wearables, and humanoid robots. I know these are words that feel sort of odd to be throwing around, but this is actually a pretty intense area of growth, because these batteries, while small, they're very cobalt intensive. They're LCO, so they're just lithium and cobalt, not nickel or manganese. And so they have a lot of a much higher cobalt content than the EV batteries, and their growth is exploding. So that's another sort of large area. I think we'll stop there in the market. I'm gonna throw it back to you, Andrew. There was a couple of questions, because you touched on what's happening at Broken Hill Technology Center, and you mentioned processing black mass, contributing to the circular economy, a few buzzwords there. Can you just sort of give us a rundown of maybe a more specific rundown? And is there a potential to add to COB's revenue mix over the next 5 years?
Sure. There are a lot of comments we can make around it. I'm going to start by saying in Australia, battery recycling is very, very low. I think all the forecasts from different groups is that maybe 2, 3, 4% of batteries are recycled. And we're excluding from that the car batteries and those sorts of things. We're talking specifically the lithium ion type of batteries. It's an opportunity there which will grow. However, Australia is a small market. But the interest in this space is really from Europe and USA, North America, where they have much bigger markets and they're putting in place the regulations and policies around recycling. Deep readers will have observed in the US-Australia Framework Agreement this week that there is a section on scrap and recycling, and that does include opportunities around these critical minerals from batteries. We think that there's an opportunity for us to take market share for cobalt and nickel and manganese from these batteries in Australia. We are looking at our Broken Hill Technology Centre as being really well matched on capacity to deal with the current collected black mass that others are collecting. For example, our MOU with EcoCycle. They're collecting batteries, they shred the batteries, they break it down, they make some black mass. Currently, that black mass is being exported. So we think there's some opportunities to break into that, and using our facility gives us a jump start on some of the other technology groups that are looking at this space, because we have a facility with capacity to process black mass at some scale. So yes, we do think there's an opportunity there. We think it ties in really well with some of that overseas interest, because ultimately long term, if we can achieve some of the processing goals, then we'll be in a great position to set up facilities overseas or to partner with some of the recycling action over there.
Thanks. Yeah, it is a pretty exciting segment, and we do get a lot of questions about that and interest, because it's new and no one else is really doing it in Australia. Giving you a bit of a macro question, Andrew, given that cobalt prices have surged so much lately, does this change any of our sort of near-term strategy, particularly around offtake or financing?
I don't think it really changes the offtake. For the refinery, we think of it as a margin business. We'll be buying cobalt at a particular index price, and we'll be selling cobalt sulfate and cobalt metal at their respective index prices. So as the underlying commodity cobalt metal price goes up and down, that will then flow through to what we buy and what we sell. And everybody can look that up and see where the spread is at the moment. And obviously it changes over time. So what the increase in cobalt price does is it just brings a bit of urgency to agreements, to people to lock down feed like we already have with Glencore. But also on the offtake side, there is certainly a little bit of a market developing where there's some urgency to lock that down, particularly now that there's a quota system in place. It effectively puts a bit of a cap or a regulated market on how many cobalt units are going to flow through the global system. And we need to be nimble and ready to pounce on those opportunities as they arise. But we're certainly seeing a little bit of urgency at the moment because of the cobalt price going up.
That's right. And as you noted earlier, that the DRC is certainly doing its best to really control that market. And given how low prices went, as low as $10, we hope that we never go back to that sort of level. Andrew, getting a lot of questions, particularly here on the live stream, about getting to FID. And again, can you sort of, I know you already talked about it, but just one more time, summarize exactly the steps to get to FID and when you think we'll get there?
Sure. There's really one critical step, and that's the offtake agreements. In addition to that, there are some minor steps in terms of documentation between Iwatani and Cobalt Blue. There's obviously a fair amount of documentation that we need to go through. But the number one step is converting our letters of interest on offtake into sufficiently binding agreements with all the requisite conditions precedent that enable the two companies to have confidence to finance the project. So that's a lot of words, but basically it is get offtake done, and then we can make the decision to push ahead with seeking finance for the project. That's it. That's the last remaining hurdle. Just to summarize, we've got the feed contract, we've got the permits, we've made product at the specification set out by Iwatani, and now we've got to get this offtake agreements in place. So it's kind of that, very, very close, but there's still that one step. Timing on that, obviously we talk to our opportunity set all the time. I'd love to have that by Christmas. In reality, is that going to be a January or thereabouts? I don't know. I can't make those promises, but that's the trajectory that we're on at the moment. Is over the next few months we want to wrap up those agreements as quickly as we can, so that we can then proceed with financing in Q1 next year. Just a little bit of background there. Financing isn't something that's going to happen in a day. It's going to take 6, 8, 10, 12 weeks to go through that period of financing, because you have to do all the DD. People will have to do some of the documentation around that. There's quite a lot of work that needs to go into that. And we want to start some of that as quickly as possible. But again, we're a little bit constrained just on where the offtakes sit, because the offtakes also drive the opportunity set for project finance. For example, you may be familiar that if you have offtake in a certain country, that country can then unlock various directives, subsidies, and so on the project finance. And so we need to bed that down to then finalize our set of opportunities on project finance.
While we're on that, a number of questions, as you can probably anticipate, just around the capital stack. How are we going to fund this thing, Andrew?
Sure. So capital stack that we've been guiding over the last 12 months is 120 million Aussie. That may change a little bit as we finalize and update our financial models. We need to do that. We need to update these models with today's pricing and with whatever we get out of those offtake agreements. So we'll be doing that in the next couple of months. But at the moment, 120 million Aussie. How are we going to do that? We're looking to split that 50-50 between debt and equity. So it would be 60 debt, 60 equity. On the equity side, we then split that further in a 70-30 ratio with Iwatani. And on the debt side, we'll be jointly seeking debt funding for the project. The equity largely is used to build the project, and the debt is largely there as working capital to fund that period of time as we go through ramp up and that validation of the cobalt sulfate to market.
But I think that's sort of a good place to wrap things up. That's what we're really focused on, is a refinery. So we'll start to end things here. I just want to say Andrew and I will be at the Noosa Mining Conference in the week of November 12th. And then right after that is our AGM, November 14th. So those are things to look out for. Before I give the final farewell to Andrew, I just want to thank all of our existing shareholders and our new ones. Without you, we wouldn't be here. And it's been a tough few years. And it's nice to see a little bit of optimism back in our space and in our share price. So thank you very much. And over to you, Andrew, for a final farewell.
Thanks, Joel. I just wanted to echo your comments. Thank you to all our long-term shareholders and the new ones that are really interested in our progress at the moment. Look, we have an open door policy, so if you've got questions and answer, please send them through, and we'll catch up with you offline. As Joel said, we have our AGM coming up in November, so feel free to drop in and say hello to us if you're based in Sydney.
Great. Thank you, Andrew, and thank you, everyone.